and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for today for about the next 20 minutes. We're going to do a short and sweet show today. It's PCE Day, which is the biggest indicator that the Fed likes to look for inflation. And the numbers came in all right. Not bad at all, kind of leading the path to a possible rate cut in September. If you toss in the good GDP number that we had yesterday, we're showing that we're having some growth in the economy and prices are not inflating as bad as anticipated. So with all that said, you're kind of looking at a Goldilocks economy where it leads for a potential rate cut. They've even talked about rate cuts in July now, which would be the 31st is when the next Fed meeting is, which was completely off the table. Now they just have a small chance of that happening, and then also leading to more cuts going into 2025. The potential has increased considering how well the market is, or the economy in general is doing. So big talk about a rotation from the mega cap tech stocks into the small cap stocks. The Russell 2000 index actually yesterday outperformed both the S&P 500 index and the NASDAQ. As a matter of fact, both of those indexes were down, where the Russell 2000 index actually had a solid gain to the upside. So I want to work on IWM today. I want to look at a very simple and sweet trade in IWM. Now, this is not as speculative. Like at the beginning of the week, we looked at a Google trade. We looked at a modified butterfly trying to take advantage of potential earnings in Google being good. We were hoping that stock would go up. That didn't work out. Those options would be expiring worthless today. There wasn't much time for an adjustment because it was an earnings play. Applied volatility came in very quickly, and the market went down right after the earnings, about the expected move, once again around 5 or 6% to the downside. And Google has kind of hung out there, not really doing much after that earnings report. But the earnings report in general was not that bad. The only highlight that some of the people or the pundits are talking about is the fact that there saw a decrease in YouTube ad revenues. So that was kind of the highlight, I guess, or if you were to come up with a reason to sell off Alphabet, otherwise known as Google, that was the only reason they could really come with. They beat on both the top and bottom lines also, so just showing good solid growth, good solid quarter. So I'm going to look at those two trades today. I'm going to look at the main paper trade for this Friday is going to be a short put spread in IWM, hoping that the trend continues. And, this is kind of a rinse and repeat strategy. I might actually look at selling the short put spread today into some strength in IWM. We're up about almost 1% in IWM today. And in the SPX, we're also up about 1%. So still showing strength in the marketplace, but a lot of that has to do with the fact that the PCE number actually came in solid. And and once again, you toss that in with the GDP number that we had yesterday, and you have an up market. Go figure. So let's run to the Tradier Pro software. And here's where IWM is right now. As I mentioned, up almost 1%, up $2. We're going to look at the August 9th expiration, which is the Friday, is a Friday expiration. I like to deal with Friday expirations. But in IWM and in a lot of the major indexes, well, the IWM is the iShares ETF that tracks the Russell 2000 index. It's extremely liquid. It's one of the things I love about that ETF. And we're going to look at that August 9th expiration. So we're going to go about one standard deviation out of the money. And if you're looking at IWM, always want to make sure that the options grid is showing you that expiration date that you think it's showing you, which is August 9th, and it shows that that's 14 days away. And we're going to look at a 1 standard deviation move, which the options grid does highlight for you with the shading. We're about 1 standard deviation move away. We're going to be on this side of the grid because these are the puts and these are the calls on this side. We're going to sell. If I look here, I'm seeing that the 16 delta option contract is actually the 211 strike. And that's the one I'm going to sell. So we're going to be selling that option contract. So we're going to hit the bid on that. And that will add the leg down below. And then we're going to go down about 5 points, and we're going to be buying this option contract. So we're looking to bring in about a net credit of about 50 cents. Right now it's showing 53 cents, but we'll round it to 50 cents. Let's just make the math simple. So if we can get it done for a net credit of 50 cents, our maximum risk is the width between the strikes, which is 5 points, minus that net credit received, which is 50 cents. So we have $4.50 worth of risk on this trade, and our maximum gain that we can make on the trade is 50 cents. Very simple, very straightforward. Looking to build some momentum going into the weekend. Shorter term trade, might be out of this trade in a week if the market stays where it's at or tends to drift higher. Also, don't mind legging into a iron condor here. So we'll look at Monday's marketplace, see where the market is at. And if the market does trend a little bit more to the upside, we might leg into an actual iron condor and bring in even more of a net credit to this position. So high probability trade, looking at selling something that is about 1 standard deviation out of the money. We're selling that 16 delta. We're going to manage our risk in this way, and that I usually, if I'm doing a 50-cent option contract, you got a high probability trade, I'm going to let that trade work a little bit. So I'm not going to get out if I lose 50 cents. In other words, I could buy it back for $1. I'm going to let this thing go to about $1.50. I don't want to lose the maximum on the trade, but I'm going to manage the risk in that way. Now, on the upside, if the market does come down, I'd have a limit order in to try to buy the entire spread back for around 10 cents. And I would definitely let that limit order live for the rest of the day today and Monday and Tuesday. So over the next couple of days, if I could buy this back for $0.10, I'm going to do that. That means that my goal is to make 40 cents on this trade. If I can get this done for that midpoint net credit of 50 cents approximately. And that's the way that I'm going to manage the trade. I might adjust it on the downside. If the markets do come back down, I might make that adjustment. But a thing that I wouldn't mind doing in the IWM, considering implied volatilities have kind of pumped up. We got the VIX trading right around 17 at this point in time, so it's still fairly high. And we got decent volatilities in the IWM. If you see this here, we're looking at a 26 percent implied volatility. That's fairly decent in IWM. So we got a little bit higher volatility, selling a little bit of that premium, trying to take advantage of that situation. Now, if you have any questions, please put them in the comment box and I can address them during the show. If you want to talk about the IWM trade, that's fine. But I also wanted to bring up on the Google trade that the trade didn't work out. I still really liked that trade, by the way, going into their earnings. But the marketplace just decided to basically buy the rumor, sell the news. Strong move so far in Alphabet since the beginning of the year. And they took that opportunity of a decent earnings report to sell off on the market. But what I'm kind of surprised is that if I run to, and I'm going to go to the charting here, and the underlying that I always like to trade, there's two of them with Alphabet. You have Goog and you have Google. So I always like to trade the Google. Those are actually the voting shares. And I'm going to highlight this one area right in here. There's some support in this area. This is where that gap is, right down around here. Kind of expected a little bit of a move back this week. I was kind of hoping that maybe we get that 5% back after earnings and actually play the hope game that our butterfly would have worked out. It didn't happen. That's straightforward. But I like this range right here in Google, and I own the underlying stock. one of the things that we could do to dollar cost average, and I don't really want to put out a lot more capital because my holding is pretty substantial, almost 20% of one of my portfolios. So if I wanted to add more to try to take advantage of this downturn that I don't really see why, I wouldn't mind being long Google going into the end of the year. That's simple. I think the markets are going to be very volatile, and I've mentioned that a couple of times through the next couple of months. We're going to get into September and October. It's going to be a little bit scary. There's going to be some buying opportunities, and then I would like to be long the market going into the new year. Now, I might not do this trade today, but I'm going to consider this trade of buying a deep in the money call option as a substitute for owning the stock. We've done this in our paper trading portfolio using the Tradier Pro software. Had a position in Lilly, had a position that has done very well. NVIDIA was another strong position. And NVIDIA is actually kind of also that opportunity. I want to see where NVIDIA is today. There we go. For some reason I can't type. Okay, so we're getting a little bit of a sell-off since the splits. The split was, so we're actually down at this point in time since the stock split in NVIDIA, and there's going to be a buying opportunity here too. So I don't mind using deeper in the money options if you own a lot of stock. I have a smaller position in NVIDIA, maybe about 10% of my longer term portfolio, but I also don't mind buying a deep in the money call option to supplement and buy the dip as far as NVIDIA is concerned. So if I'm going to add to my positions in Google and NVIDIA, this is the way that I would prefer to do it. So let's look at Google to start, because that's really what the focus was. And I'm going to go to the new year on this. And you could almost call this a fear of missing out. The market has taken a downturn, a little bit of volatility going into the marketplace. September and October always kind of make you a little nervous, but I do want to be long going into November and December. Looking at the January 17th expiration, that's 175 days away. I don't mind going out to September, but I'm going to use this expiration because the options are going to be a little bit cheaper, and I don't want to scare you with the price of the option contracts. But if I'm looking at this, the 145 strike is trading for an 80 delta, like that strike. We got decent markets. The markets in deep in the money, longer term option contracts are never great, but sometimes they're good. And in Google, we have that situation. We got a 20-cent bid-ask spread on a $29 option. It's not the stock, but it still isn't a bad scenario. So we're going to put this simple trade on as a paper trade. I don't, if you wanted to try to take advantage of the fact that Google has sold off a little bit after their earnings, this is the way I might do this. Here's the expiration. 2025, January 17th, 145 strike. It's an 80 delta option contract. I'll highlight that right there. And we're going to be paying about 29. We're going to go for the midpoint here, 29.20. No guarantee of a midpoint fill. So $2,920 is going to be our max risk on this trade. So if we compare that to 100 shares of Google at $166, so 29.20 divided by 166.56 is 17% of the stock price. So if you bought the stock on margin, right, you'd have to put up 50% in most cases, which would be a lot more capital in order to do this. We're putting up about 17%. We're getting something that represents the stock very well. We're getting 80 delta. That means if stock goes up 1, our option contract should go up about 80 cents or $80 in a one contract situation. So this is the alternative. This is an alternative to adding a lot of capital, $16,600 plus dollars in order to buy 100 shares of it. But we're going to look here at $2,920 and get real representation on Google. Also, wouldn't mind maybe selling a call against this position going into the end of the month before, well, I'd say the end of August. I would go about halfway through the month in August and look at maybe selling some calls on that position just for the short term. And that's the way that I would trade this. All right. So if you have any questions or comments, please put them in the chat box right now while I am signing off. And we have a short and sweet Options Guide TV today. I'm not going to really come back and look at the Google trade much because I think that's kind of it's a long-term hold. We'll look at it maybe at the end of the year when we break out the paper trading deep in the money call portfolio. But we will definitely look at the IWM trade on Monday, see if we want to turn that into an iron condor or if we just need to adjust the trade if the market does actually sell off going into the close today. My name is Brian Overby, author of the Options Playbook, Options Guide TV, Monday, Wednesday, and Friday at 11 a.m. Eastern Time on X.com. You can watch it on YouTube under the Tradier YouTube channel and also inside the Tradier Hub. Thanks for stopping in. We'll see you this Monday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.